Nice to see you again. Let's just immediately start. So, um, when it comes to chain transactions, there is one last very interesting part, the so-called triangulation rule for chain transactions. That, yeah, the first question there is just what's the problem? Let's just start at the beginning. To understand the problem, let's remember the last slide from the previous video. There was a constellation where A, B, and C had contracts with each other, and the delivery went to from Aachen to France, or better, the transport. The transport was done by A, so we had the following constellation. The good goes during transaction 1 from Aachen in Germany to France. Then that crosses the border, and in France it stays during the second delivery. So for A, there is an inter-community delivery, tax-free. For B, there is inter-community acquisition, but in France, because the good goes to France. Then the second thing is also a domestic VAT thing in France again, and then from the acquisition in France, B has an input tax deduction claim in France. So that means that our guy has three things to declare in a French tax declaration. That means he needs to bother about how to fill out a French tax declaration, needs a taxpayer number from France, needs a tax advisor from France, all that stuff. So that's highly expensive. Several thousand euros will result as administrative costs from that single transaction. Now imagine the good involved in that chain transaction might have been only a small item with a value of 100 euro. Then we would talk about a turnover of 100 euro and costs of several thousand euro for the bureaucracy, just for VAT purposes. So that's not nice, huh? So let's look how the individual people are affected. We have already seen the consequences for B. When we have a look to A situation looks relatively proper. A sends the good from his own country. He has an inter-community delivery that's free of tax. He only needs to declare something in the recapitulative statement, or better called EU sales list, and that's it. No contact to another country or to the tax administration of foreign countries. Everything is fine. A has no problem. So whenever you think about a simplification of the bureaucratic procedures here, you don't need to change anything as far as A is regarded. So no problem here. So the triangulation rule will also respect that and leave A situation completely unaffected. Nothing happens for him. The problem is, however, B in the middle, the guy with the three lines in the foreign tax declaration. How can we perhaps try to help him? The first idea which people had in mind when they thought about a legal simplification rule for his situation was, do we really need to insist in that he fills in a tax declaration for the IC acquisition? Because he will automatically get a complete input tax refund claim. So why can't we net it off against each other and declare it as done? So to skip the two lines. That does no fiscal damage because there is always a 100% correspondence here. So one could just say you don't need to hand in your tax declaration in the country of destination, no fiscal damage done. So we would free him of two of the three lines, and this sounds like a great achievement. However, it has no effect for him. because having to declare one single line in a tax declaration in France has the same bureaucratic problems as declaring 3 lines. That doesn't make your tax advisor cheaper. So that solution alone is not very helpful. We need another idea which might bring also the third line in the tax declaration in France away from B. So what could we do? So the second subsequent question is, how can we get rid of the third line in the foreign tax declaration? And now the idea is, think about the reverse charge idea. Why can't B's foreign customer C pay the VAT for his acquisition, for his purchase in his home country alone himself? That solution, however, can only be considered seriously if the customer is also an entrepreneur or at least has a VAT identification number. So if he knows how to deal with VAT rules. However, that will be relatively frequent. So we could seriously consider that. If we say B to C, in that case, we just shift the tax declaration and tax payment duty to C, the final customer in France. Then B has got rid of all the lines in his French tax declaration. He doesn't need to register. Everything's fine for him. The only problem which is left over is probably, does it affect the situation of C in some inconvenient way, and how can we check the whole thing? So if you look to C, he gets something which comes from Aachen, but it's a domestic case because it has already been in France when he acquires it. So we just talk about domestic French tax, and he is called up to pay it. Then very often he can deduct it as input tax directly. So for him, probably it has no negative liquidity effect or bureaucratic effect because he already hands in the tax declaration in his own country. So he would only have to add in an additional single line to fill out the answer to one question: did you acquire things during a triangulation constellation? That's no additional bureaucratic burden. He even has a slight financial advantage because he only needs to pay a net price now to his supplier B, so he can keep the amount of the VAT a bit longer till the end of the month. So no big problems for C. It's basically the same fiscal and bureaucratic consequences as in case of reverse charge. If he deals with other foreign suppliers, he's already used to the possibility of reverse charge constellations. So that would be a great idea. So it works. So we can sum up the basic idea of triangulation cases is, first, we want to have it as a simplification for the middle person in the chain. If that middle person in the chain ends up with having to hand in a tax declaration in a completely foreign country with which he or she has nothing to do until now, then we want to help them. So the simplification idea has just these two ideas in combination. First, the intra-community acquisition, and the corresponding input tax is just netted off against each other, so it's both ignored. You don't need to declare it in the country of destination because it's always plus minus zero in the total effect. And second, the internal domestic tax for the second transaction is shifted to your customer in that country. And if these two things together are possible, then you can try to opt for the triangulation treatment under a special VAT rule. That is simple. Huh? Where the person in the middle of the chain has not an inter-community acquisition, you can immediately see then the whole idea can't work. Or when he doesn't have an inter-community acquisition in a country which is foreign to him, then he doesn't need a simplification, because then he hands in already a tax declaration there. But back to the roots. So when would triangulation not work? Where there is no intra-community acquisition for the middleman in the chain, there you can't renounce on intra-community acquisition taxation. So the basis is then not there. Or you can immediately conclude it's obvious that the simplification rule for triangulation cases can't apply. Examples where that could happen. We have A, B, and C from 3 different countries. We have C doing the transport. So the first delivery is without movement. The second one is with the transport. Here it crosses the border. So we have an intra-community delivery here with B in Belgium and the IC acquisition with C in France. And we have an inland delivery between A and B. So it's immediately evident that you cannot net off IC acquisition and input tax from it for B, because B doesn't have that. And you can't shift the tax burden for contract number C to C, the final customer, because he already has that tax burden. So definitively no case for the application of the triangulation case simplification rules. Another example where you can evidently not interpret the situation as a triangulation case. That's again A, B, and C. C is in Chile, B is in Brussels, and here the good goes from Aachen to Chile and is then sold on within Chile. There's no way to apply the triangulation case rules, because you can't net off an IC inter-community acquisition for B in a foreign country, because Chile is a third country. There can be no inter-community acquisition. So the idea is already dead and gone before you even have a second look. What also might happen is this. A does the transport, but as you see here at the end, C is now a private person. So you could net off the ICE against the input tax. However, that doesn't help you, because if you have a private customer, then the seller necessarily must pay the tax to the country of destination. So here a B can't avoid to pay taxes in France, to register, to hand in a tax declaration. And if he has to do this, then he can also regularly declare the intercommunity acquisition and claim the input tax, because the bureaucratic hurdle and the expensive step, that's not 3 lines. That's just to fill out the form as such. Even if it makes no difference if you fill in 1 line or 3 lines in full. So that makes clear triangulation case rules can't apply here. You need a final customer who is an entrepreneur, or at least fills out a tax declaration, so has a local VAT identification number. Yeah, what else? A, B, and C again. C is now from Spain, but the good goes to France, to a trade fair ground in France. C, however, is from Spain, and now A does the transport, so we have again this constellation. So we have intercommunity delivery for A, and A is happy. B has intercommunity acquisition in France, has a domestic tax in France. Setting off the ICE against the input tax resulting from it would work. However, by shifting the tax burden from the supplier B to the customer C, who is also not yet registered and taxable in France, that would be a relief for the one and be a shock and an additional bureaucratic burden for the second guy. So you would do one a favor and you would ruin another one. That's basically not a fair solution. To help one to escape the rules and to burden somebody else with something which the rules normally don't entail, that's not justifiable. That cannot be seen as a fair idea. So you cannot treat that as triangulation case either. So when can it work? Where you have an ICE tax, which you can offset against the input tax claim resulting from it, and where you can shift the tax burden number 2 from the seller to the buyer of the good, because the buyer of the good is resident in the country of destination. So then triangulation rules should always be tested, and the costs which you can save are always worth going into details. So that's something which you should immediately recognize whenever you make a sketch of your personal situation where you are involved in a chain transaction constellation. So naturally, there's one risk. If C now gets a good, where B, the seller, doesn't charge VAT, trusting that C does it, C has to do it like under the reverse charge mechanism, same idea, then humans are humans. C could be tempted to say, let's forget about the whole stuff. Nobody will ever find out. I don't pay VAT on the goods which I acquired, or even better, I don't even show them in my books, and I sell them afterwards undercover, untaxed to final consumers. Nobody finds out that I bought these things, because all the papers proving it are outside my own state. My own fiscal administration can't get hands on them. So there should be a control mechanism to find out if people lie. Huh? For this purpose, one wants to use, or one uses, the EU sales list or recapitulative statement. So B should name C with a VAT number from the right country, that's the country of destination, as his customer. So if then B doesn't need to pay the tax, C can't escape the tax supervision of the country of destination, because they automatically get the information from B's country where he hands in his recapitulative statement. So they get the information that the whole thing happened. So he can't escape taxation. And this naturally must also be secured that this can work. So finally, when it comes to the details, you will have to check a catalog of technical details. If they are fulfilled, then it is a triangulation case. If they are not fulfilled, then check. So in Germany, there's a list of all in all 8 conditions which have to be checked. They are distributed over 2 subparagraphs of paragraph 25b. So in total 8 conditions, and here they are. There must be a chain transaction, 3 persons involved who are all entrepreneurs. These entrepreneurs must be registered in different member states, which has as its consequence that they have VAT ID numbers from different states. That will be important if you want to use the EU sales system to check and to communicate cross-border that there's something going on. The good in question must go from the territory of one EU member state to the territory of another one, because otherwise you never have an intra-community acquisition and you never have our constellation where we talk about. The dispatch of the good in question is made by the first deliverer or first customer in the chain, because otherwise you don't have that intra-community acquisition. And before the second delivery, there was an intra-community acquisition. It's then explicitly stated. God knows why, because it's basically equivalent to a combination of condition 3 and 4. The person in the middle of the chain is not resident in the country of destination, because otherwise he would be taxable there and wouldn't need any simplification rule. And that person uses the same VAT number of a state who is not identical to the first and the last state during the contact with the first and the last state, guys. The invoice issued by the person in the middle must not contain VAT, but must contain a hint, a clear remark which informs customer C, the last one in the chain, that he is forced to pay the VAT for the transaction in question. And the last person in the chain must have a VAT ID number of the country of destination of the good. So if you have a look on these 8 seemingly complicated questions, you will see that this, and this, and this conditions basically just are the conditions which make sure that we have the constellation which we talked about, ICE, intercommunity acquisition, input tax resulting from it, plus national domestic internal tax for the second transaction. That is always given if these 4 conditions here are met. Then the entrepreneurs must be registered in different member states, and the person in the middle of the chain is not resident in the last country, the country of destination, and that the same VAT number must be used in contact with the first and last person in the triangle. That basically makes sure that you can check the whole constellation through the EU sales list declarations. And last but not least, this condition number 7, the invoice issued by person number 2 must be net and doesn't or must not contain VAT. That is the condition which makes sure that customer C is informed about his duty to pay the tax, and that there is no excessive VAT overcharge in the sense of paragraph 14c. So basically also that, if you understand the basic logic, not so complicated. One question remains: can triangulation cases also show up with more than 3 participants? Originally people thought that's not possible. However, the E-Commission and following it, German law insists, yeah, it might be possible. The simplification rule is meant for the benefit of people, and you should not deny its application wherever it could technically work. So it's not officially restricted to constellations with only 3 persons. However, it depends very much on the situation if it can work. It does not work in every constellation, but only in rare constellations with more than 3 people. For this, let's look to examples. First example is A, B, C, D from Aachen, Belgium, Spain, and Denmark. Now C does the transport from Germany to Denmark. That means contract number 3 is the one with the movement. No, sorry, mistake. C does the transport, and you see, well, I'm an idiot, because you remember, if somebody in the middle of the chain, and C is in the middle of the chain, uses does the transport, then he has two possibilities. And if he does not deliberately choose that the second alternative, that would here be contract number 3, is to be treated as the transaction with the movement, then it's automatically the first contract where he is involved. That's number 2, the delivery towards him. That is seen as being the transport. So we have here the transport from Aachen to Denmark, corresponding to transaction number 2. Then the next transaction, the good is already in Denmark, it stays in Denmark, and the first transaction, the result is it began in Aachen and the good stayed in Aachen. In that constellation, as you see here, we have crossing the border, and we have an intra-community delivery from Aachen to Denmark for B in Brussels. We have an intra-community acquisition for C, but not in Spain, but in Denmark. We have the input tax granted for that, and we have a domestic tax inside of Denmark for the following transaction. So we have exactly the constellation, which is the constellation for a triangulation. So it should work. Example 2, same constellation. Now B does the transport. B, as you see, is also in the middle of the chain. You remember that rule that B has a choice, and B can choose um, to use a Belgian or a German VAT number. He uses his Belgian VAT number. That means that A is not hindered to see his transaction as the one with the movement. So the first situation, the first transaction is seen as the one with the movement. And that means the second one is Denmark, 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 Denmark. So we have IC delivery for A, we have inter-community acquisition for B, we have input tax for deduction for him, we have a domestic tax for him in Denmark. So B is now in a situation where he has all the 3 conditions of the constellation fulfilled. So it could work. The only thing which would be required is that C, although from Spain, should also have a Danish, not Spanish. Sorry, I must change. So let's try it again. So he would need to have a Danish VAT number, because naturally the customer C in the triangulation situation needs to have a VAT number from the country of destination. Now C might, from previous transactions or so, indeed have such a number. If he does not yet have it, he will need to register in Denmark subsequently, because yeah, not always. Might also be that for transaction number 3, he there is a reverse charge rule in Denmark. One doesn't know. So it really depends on the circumstances. But if C has or can acquire a Danish VAT number, then it would be convenient for B and possible for B to opt for the triangulation rule. So what B probably in reality would do, he would ask C, do you have a Danish VAT number which I can use? Then I can treat my stuff as a triangulation case that saves you money, and I probably would be very grateful if you could furnish me such a number of yours. Again, A, B, C, D, triangulation, what happens? B does the transport now, and he uses a German VAT number now. So Aachen, Aachen. That means for A, the idea that there should be an intra-community delivery is definitively blocked. A cannot declare an intra-community delivery from Germany to Germany. So it's clear that the second transaction is the one with movement of the good. So B has to declare an intra-community delivery in Germany in the EU sales list in Germany. That will not shock him very much because I say he uses a German VAT number, so he evidently, for other reasons, already hands in a tax declaration in Germany and already has a German tax advisor. So for him, that might be a nice solution. Now looks to what happens in for C from Cordoba. Here's an inter-community acquisition again. Input tax for that. He has the domestic next delivery within Denmark. So he has now exactly the triangulation constellation. So probably it will work. The idea numbers also fit in because D from Denmark will in all probability already have a Danish VAT identification number if he is an entrepreneur. So the only technical thing which then has to be checked is, do all people involved have the necessary VAT identification number? And the entrepreneur in the middle of the chain has to make use of the triangulation rules to inform his customer with a remark that the transaction is to be paid by the customer, so that is a triangulation case. Additionally, he has to notify the other fiscal authorities by the EU sales list, listing the transaction and giving the VAT identification number of his customer from the country of destination of the good. And furthermore, the VAT identification numbers of the persons involved have to be noted on the invoice so that any tax advisor, no tax inspector can immediately find out that the whole thing can at least have been handled properly, because otherwise, if the numbers were missing, then you would already have to suspect, okay, if they don't know the VAT number of the customer, then evidently the matter can't have been dealt with correctly because the declaration duty can't have been fulfillable. There is, however, one last aspect, which I quickly need to mention. When the person in the middle of the chain uses a VAT number for the EU sales list to declare his intra-community acquisition and the following triangulation transaction with C, the final customer, or his customer in the final country of destination, then he uses a VAT number of the wrong state because he doesn't have, by definition, he doesn't have a VAT identification number of the right state, the state of destination. Now, you might remember that making an intra-community acquisition by using or under the number of the wrong state triggers an additional punitive intra-community acquisition tax in the country of the number. So according to the basic rules, by using the VAT identification number to allow A to declare successfully an inter-community delivery and then not registering in the country of destination would trigger this punitive tax if B, for example, from Belgium, buys a good under his Belgian VAT number, although the good goes to Spain or to France. However, if it's a triangulation case, this punitive tax under the basic rule falls away at that point of time when the taxpayer can prove that he paid the acquisition tax correctly to the country of destination. That's also in 3D sentence 2. Now, the triangulation rule says explicitly that the declaration of the ICA and the input tax claim in the country of destination need not to be made because they are deemed to have been paid and deemed to have been refunded accordingly. So the proof that is required by 3D sentence 2 to cancel that punitive tax is automatically given by this fiction in the situation, in the constellation of a triangulation case. And thus the punitive tax dies in the very same moment when it begins to exist. Somebody sends a good from Aachen to France, let's say, and the Belgian buyer buys under a Belgian VAT identification number. Officially, that's forbidden. It would trigger a Belgian tax on acquisition. However, as under the triangulation rule, the tax in Spain, the ICE tax in Spain, is deemed to have been paid correctly. The Belgian punitive tax dies a millisecond later again. So that poses no problem. Huh? Okay, so these details should be enough for today, and probably enough for chain transactions. Oh my God, I'm stammering massive times today. So what remains to say is just thanks for watching, and I wish you a good time till next time, till we see each other again. Thanks and goodbye.